Hi everyone, welcome to my channel. So today we are continuing with the CFA Level 2 Economics Chapter 1 video series. So in this video, we are covering the section Forward Markets. So let us first understand what is a forward contract. So you might already know what a forward contract is from CFA Level 1 derivatives subject, but a quick recap with regards to FX market. So a forward contract or forwards, like forward contract can also be called as forwards. It is, what is it? It is an agreement. It is an agreement to exchange one currency, one currency for another on a specified future date at a price agreed today. That is uh, when the contract is made. The day contract is made. So, what is a forward contract or forwards? It is an agreement to exchange one currency for another on a specified future date at a price agreed today. That is the day on which the contract is made. So, on a future date, example 3 months from now, I have entered a contract to sell USD and buy INR, and the exchange, but the price at which this exchange would take place, I have agreed today. That is the day in which the contract is made. So that is known as a forward contract, an agreement to exchange one currency for another on a specified future date at a price agreed today. Now, in this part of the curriculum, in this part of the CFA curriculum, instead of the P by B notation, we would be using the F by B notation. So we know that P by B stands for price currency, and base currency. Here F by B would stand for foreign currency, F would stand for foreign currency, and B would stand for domestic currency. So F would stand for foreign currency, B would stand for domestic currency. So in this part of the curriculum, instead of P by B notation, we would be using the F by D notation. Okay, so this is the notation we would be using. Now, what is the difference? Actually, there is no such difference. So here, actually, price currency is the same as foreign currency, and base currency is the same as domestic currency. So instead of price currency, we would use the term foreign currency, and instead of base currency, we would be using the term domestic currency. So see, P by B, it would be mentioned as F by D. That's the only difference. Here, F stands for foreign currency, which is same as price currency, and D stands for domestic currency, which is same as base currency. Okay. So now we have to actually, the most important part of this section is to understand a formula. But to understand that formula, we would need to derive it. So we can derive it with the help of an example. So the example that I'm using is an investor is looking at a currency pair, and the currency pair is USD to INR, USD to Indian rupee. Now, what the investor wants to do is, investor wants to. So I'm taking a really simplified example. So in this case, an investor with 1 unit of domestic currency. So which would be the domestic currency in this case? if the investor is looking at USD to INR. So an investor with 1 unit of domestic currency, so it is 1 INR, wants to invest it for 1 year, wants to invest this 1 rupee for 1 year. So invest it for 1 year. So the reason I'm taking 1 rupee is because it's easier to derive the equation when we are considering 1 rupee. That's why I'm taking 1 rupee. I know it's really a small amount, but just to derive the equation, it's easier to think of 1 unit of the domestic currency. So an investor with 1 unit of domestic currency, so in this case 1 INR, wants to invest it for 1 year. So what are the two options the investor has? So in this case, investor has two options. Investor has two options. So the first option A, that is, one second, yeah, A, that is the first option. It is invest 1 INR for invest 1 INR for 1 year, 1 year at domestic risk-free interest rate. So the domestic risk-free interest would be denoted as small I to INR, which is equal to domestic risk-free interest rate. So now at the end of year one, so at the end of year one, the investment return return would be equal to 1 INR into 1 plus the domestic risk-free interest rate. So that is the our investment amount plus the interest that we have earned from the investment. So the investment return would be 1 into 1 plus domestic risk-free interest rate. Okay. So this is the investment return in first case. Now we look at the second option. Second option. So in this case, since we are looking at USD to INR currency pair, what the investor will do is, first, the investor will convert INR to USD. At what price? At the current USD to INR spot rate. So the investor would convert INR to USD at the current spot rate. Then after converting and getting USD, the investor would invest the converted USD, invest the USD. So invest USD, 1 minute, invest converted USD amount at foreign risk-free interest rate, at foreign risk-free interest rate, which would be equal to, which would be denoted by USD interest rate. So what the investor is doing is, he would first convert INR to USD and then invest this USD at uh, US interest rate, US risk free interest rate. Okay. Now, once he has invested it, after 1 year, what will be his return? After 1 year, so at the end of 1 year, the end of 1 year, that is the investment period, the investment return would be equal to investment return would be equal to that is the investment would be equal to uh, first we had converted the Indian rupee to USD, right? So that's why spot exchange rate is taken. So that would be in USD terms because uh, at base, the base currency or the domestic currency is INR. So the exchange rate would be denoted in terms of price currency. So here the spot rate would be denoted in USD. So that amount into 1 plus the foreign interest rate. That is USD interest rate received from USD investment. Okay. So now we got it, but this investment is denoted in which currency? This is in USD currency. This investment return is in USD currency. So now the investor initially invested wants to invest INR and get return in INR, right? So now what the investor will do is the fourth point is investor will convert this the convert this USD amount USD return back to INR. Okay. So now to convert USD to INR. So this is the important point. What will happen? So this exchange rate, this conversion is going to happen 1 year from now. So this conversion is going to take place after the after 1 year, right? After 1 year, that is the investment period. So now since the investment return would receive it only after 1 year, when the investor is converting it back to 1 year, the exchange rate for this conversion, the exchange rate for this conversion, what will the investor do? Because the investor wants a risk free return, the exchange rate for this conversion, the investor will set at the beginning of the investment period. So the exchange rate for this conversion, USD to INR conversion at the end of 1 year, this exchange rate would be is set at the start of the investment period. Okay. Why is that? Because it is done because using 1 year forward interest rate, using 1 year forward contract for exchange rate, uh, exchanging the currency at the pre-agreed price. So using 1 year forward, investor can eliminate FX risk in future. Investor can eliminate future FX risk, like the risk of any one currency uh, appreciating or depreciating. So investor can eliminate future FX risk. Okay. So now this forward rate. So investor will set 1 year forward rate. So the forward rate is denoted with the letter F. So forward rate for foreign to domestic currency. So in this case, forward rate for USD to INR. Forward rate for USD to INR. So this would be the forward rate. But the problem with this is now again the base currency is INR. So forward rate is in terms of USD. it's in terms of USD, that is the price currency. So it is in terms of USD, that is the price currency. So now to convert it back to INR, I would require the amount in terms of INR, right? So to get the amount or exchange rate in forward exchange rate in terms of INR, what will happen? To get the forward exchange rate in terms of INR, it is very simple. I will invert this amount. So 1 by forward rate of USD to INR would give me the amount in terms of INR. Okay, so that's what we will do. So now at the end of year one, hence, so this is the important point. Hence, at the end of of year one, uh, investment in terms of domestic currency would be equal to, so at the end of year one, the investment in terms of domestic currency would be equal to, first, what will happen? Using the spot exchange rate, in the beginning, I converted uh, INR to USD. Then I invested it for 1 year at USD's risk-free interest rate. Now, after 1 year, I have this return. I want to convert it back to INR, but the exchange rate at which I would be converting it back is already set at the beginning of the contract, at the beginning of the investment, and that is the forward rate. But the forward rate is in terms of, again, USD currency. So to get it in terms of INR, I have to use inverse, that is 1 by F of USD to INR. So this is the final equation that will give the return of, in terms of INR after 1 year. Okay, so this is the return from second option. Return in terms of second option. Okay, that the investor chose. So now what we have to do is, since both A and B, since both options A and B are risk free, since both options A and B are risk free, both should give the same return. So both investments should give same return. Same return. Since both investments should give same return, uh, because if both investments don't give same return, if not, arbitrage opportunity exists. If not, arbitrage opportunity exists. Arbitrage profit opportunity exists. Okay. So since both options should give same return, we can equate both these equations, right? So this is second option's return, and this is first option's return. So since both uh, the investments should give same return, I can equate it. So it would be equal to. So this can be written as, since both return should be same, the equation can be written as 1 into 1 plus risk-free interest rate for Indian rupee is equal to spot rate USD to INR uh, USD to INR into 1 plus interest rate of USD and converting it back to INR. So the forward rate, inverse of forward rate. Okay. So for a 1 year, 1 rupee investment, this is how the equation would look. But now the reason uh, this equation looks so simple is because the investment period is also taken as 1 year. So in this equation, the investment period is also taken as 1 year, right? So this has investment period of 1 year. Of 1 year. But if I'm investing not for 1 year, but for probably 1 month, that is 30 days, or if I'm investing for 6 months, or probably 250 days, so in that case, how will the equation look? So, for this equation to hold for any time horizon, for this equation to be relevant for any time horizon, for any investment time horizon, I have to take the risk-free asset. Like I have to look into the interest rate. That interest rate has to be adjusted for the time horizon that I'm investing. Like if I'm investing for 30 days, then the interest rate has to be adjusted for that 30 days, right? So for this equation to be relevant for any investment period, interest, the rest rate should be adjusted, should be adjusted for the investment period, investment duration. So in this case, we have taken risk-free interest rate. So risk-free interest rate of any country, risk-free interest rate of any country, which is it? MRR. Interest rate is usually considered as MRR, that is market reference rate. Now in the case of market reference rate, usually uses the MRR uses day count of actual uh, to 360. So MRR, that is market reference rate calculation, when we are using that, we'll take the time duration like day count as actual by 360. So here 360 is 360 is considered as 1 year. So that is, we consider 1 year has 360 days. And then actual means the time duration for which I'm investing, the number of days for which I'm investing. Investment, invest, investment days. Okay. So that's the convention that so actual to 360 is the convention that curriculum uses. Curriculum mostly uses, and most countries also use it. But an exception would be GBP. So in the case of GBP, uh, it uses actual to 365 days a year. To 365. That is 365 days a year. The reason why curriculum mostly uses this is because actual by 360 is easy to calculate. Ease of calculation. Okay. So now, if I'm taking the if instead of 1 year, if I'm taking any other investment time horizon, then I'll have to adjust the equation for the investment time period. Finally, we are arriving at the weighted equation. So the equation will now be 1 plus interest rate of INR, so domestic interest rate, into actual by 360, actual divided by 360. This should be equal to spot rate of foreign to domestic currency into 1 plus interest rate for foreign currency adjusted to the investment period, that is actual to 360, and then this is being converted back to domestic currency. So 1 by f of foreign to domestic. So this is the equation. Okay. So this is the important equation that you guys should memorize. Like if I'm investing uh, a domestic currency at risk-free interest rate, and then if I'm investing the same currency at a risk-free interest rate at a foreign country, and the return is same, then how can I calculate it? So this is the equation. Okay. So now we found the equation. Now using this equation, I can take the forward rate to one side. Using this equation, I can take the forward rate to one side. So if I take forward rate to this side, it would be equal to the forward rate for foreign to domestic investment, or USD to INR investment, will come to be F of FD is equal to the spot rate. This side will go to the denominator. So this would be equal to 1 plus interest rate. I'll just write it down. Actual by 360. And this will go to the denominator. 1 minute. 1 plus actual by 360. So this is the whole equation to calculate forward interest rate. Okay. So this is the equation to calculate, not forward interest rate, the price for forwards, the forward currency, the price for forward, the price at which the currencies would be exchanged. Okay, so this is the forward price. And this is the equation to get forward price. Okay, so by heart this equation. Now, this equation, what does this describe? So this equation describes, so this equation is the way to calculate the forward price for currency exchange. So this equation describes the covered interest rate parity. Covered interest rate parity. Why is that? It is because this is based on this equation is based on risk-free interest rate, spot rate, and forward rate. So it is actually in this equation, before this forward rate, if you look the above equation, like the forward rate equation is also calculated from the above equation. So this equation actually is a way that both the investment returns, that is investing it at domestic country or or foreign country, is giving you the same return. So that's why it is covered, that is it is currency hedged. So the it is covered or currency hedged equation. It means that the rate differential interest rate differential return between two markets, between the domestic market and the foreign market, between the two markets is equal to 0. It means that the domestic market return would be equal to the foreign market return. That's why it is currency hedged. Okay, and that's why this equation is called covered interest rate parity. Okay, so this is an important equation, everyone. So kindly learn this equation. Okay, so now we will move on to the next section. So in this the above equation can be rearranged. So the covered interest rate parity equation can be arranged to get, I'm not showing the rearrangement because it would be time consuming. So the covered interest rate parity can be rearranged to give forward premium or discount equation. So this is the upcoming equation is also very important to study. So the forward premium or discount equation. What is it? The forward premium or discount, because it would be discount if the amount is negative. The result from the equation is negative. If the result from the equation is negative, it means it's a discount, forward discount. So to calculate it, 1 minute, yeah. The equation is the forward price minus the spot price is equal to spot price for foreign to domestic currency into actual by 360, the whole divided by 1 plus domestic interest rate into, so here, okay, actual by 360. Now this whole is multiplied with interest rate of foreign, risk-free interest rate of foreign currency minus risk-free interest rate of domestic currency. So this is the important equation. So this equation gives you what? This equation gives you forward premium or discount equation. So this is the forward premium or discount equation. It is very important. Do study it. Okay. So the ones I'm highlighting in this manner are the important equation to study. That's why I'm highlighting it in this manner. Okay. So now again I'm going back to the concept that this equation can be rewritten in the form of price to base currency, and to rewrite in the form of price to base currency, it is simple. Instead of F, you can write it as P, that is price currency, and instead of B, you can write it as B, that is base currency. So if I quickly write it down, it would be equal to forward price minus spot price is equal to spot price into actual by 360, the whole divided by 1 plus interest rate of base currency by actual divided by 360 into, 1 minute, into interest rate of price currency minus interest rate of base currency. So this is how I can write the equation in terms of price currency and base currency. It is exactly the same. I have only replaced the foreign currency with price currency, and I have replaced the domestic currency with base currency. Okay, so you can remember it in this format as well. Now the next concept is based on the equation. So based on the above equation, What we can understand is, so based on the above equation, so I'll bring down, since we are discussing everything in terms of uh, domestic currency and foreign currency, I'll bring down this equation. Okay, so uh, the important thing to note is that uh, domestic currency will trade at a forward premium. Domestic currency, domestic currency will trade at domestic currency, that is the base currency, will trade at forward premium. So what is a forward premium? It is when the side of the equation, that is forward price, would be greater than spot price, and it will be positive. It won't give a negative amount but a positive amount. So when forward price is greater than spot price, domestic currency will trade at a forward premium, but it is only if the foreign interest rate is greater than the domestic interest rate. Only if the foreign interest rate I is greater than the domestic interest rate. So the domestic currency would be trading in forward premium when foreign interest rate is greater than domestic interest rate. So Indian rupee INR will trade at a forward premium if the interest rate in United States US is greater than domestic interest rate, that is Indian interest rate. Okay, so now we have found we have understood how the forward premium works. So similarly, 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 if the domestic currency is trading at a forward premium, if domestic currency trades at forward premium, what would it mean? It means that if domestic currency trades at forward premium, what would it mean? It means that the foreign currency is trading at forward discount, because if one is trading at premium, the other should trade at discount, right? Only then both sides can be equal. Okay, so domestic currency trades at forward premium means the foreign currency is trading at a forward discount. Now why is that? Otherwise, it is possible, like, if this is not the case, then it is possible to earn. So if this is not the case, then like there would be an interest rate differential. Like one country's interest rate would be higher. Like so if INR, or if domestic currency trades at premium, then domestic currency's interest rate would be less. Uh, Similarly, if domestic currency is trading at premium, it would mean that the interest it would mean that the foreign currency is trading at a forward discount, and the foreign currency's interest rate would be higher. So it is, in simple terms, if I invest, like it is possible to by earn more interest in foreign market. But what will happen is that even if the interest rate in foreign market is higher, but the forward discount will offset the higher interest earned. So if USD is giving me a higher interest and I I convert INR to USD and invest so that I get the higher return from USD. But because it is a covered equation, that is currency hedged equation, even though I earn a higher interest in USD, the moment I convert it back to INR, the forward discount will offset the higher interest earned, and it will give me the same return that I would have earned at by investing in a domestic market, investing it at domestic risk-free interest rate. Okay, so that's all. Now, one thing we can note from this equation is uh, the premium or the discount. So this side is the premium and discount. The premium and discount is directly proportional to the spot exchange rate. It is directly proportional to the interest rate differential, and it is approximately proportional to the time to maturity. So the forward premium or discount is directly proportional to spot rate. It is directly proportional to interest rate differential, and it is approximately directly proportional to the investment time horizon, that is time to maturity. So based on that, the forward premium or discount changes. This video was a lengthy one, I know. So that's all for today's video. In the next video, we will solve two examples using the equations that we have already derived. Thank you.